Hi guys, this is Mr. Tan, and today we're talking about the profit and loss account and the balance sheet. And we'll be bringing in different ratios, and we'll be looking at how important it is to look at your costs, look at your expenses, and look at your cash flow as well. So if we start with the profit and loss account, we can see the example here whereby you've got your total sales, and then in order to get your gross profit you take away your total cost of the sales, or your cost of goods. So you have your sales minus your cost of goods or cost of sales, which gives you your gross profit. So in here, the example we've got between 2006 and 2017, we can see an increase in the gross profit between 2016 and 2017. And then in order to get the net profit, we add up all the expenses in the business, like wages, account levies, donations, entertainment, electricity, insurance, clothing, rent. So all the depreciation, telephone charges, and all the expenses of the business, you total that up, and you take that away from your gross profit, which gives you your net profit. And obviously your net profit is very, very important, because your net profit is going to be what your shareholders are looking for eventually to get a dividend. Now when we look at these, we also can compare these from year to year to see if we are performing or underperforming or what's happening. But we can also compare these in terms of ratios. And if we wanted to get the gross profit percentage margin, then we divide the gross profit by the total sales times 100, gives you your gross profit percentage margin. And likewise, you could compare the net profit percentage margin by dividing the net profit divided by total sales times 100. And the purpose of finding out the gross and net profit percentage margin is to compare it with industry standards, not only to find out if we're gross profit and net profit, finding out from year to year if we're doing well or worse, to find out how we are compared to the industry. So this is very, very important when we look at these ratios. Now when we look at the profit and loss account, this actually helps us to decide where problems may exist or where future strategies might exist to help the company move forward. For instance, if your net profit was too low, then where could the problems be? If net profit was too low, where you're not even giving a dividend to the shareholders eventually, then it could be that you've got too many expenses within the business. Maybe you've got too many staff. Maybe you're not being as productive or efficient as you need to be. So maybe you need to cut down in terms of your expenses. And the more expenses you cut down could mean that you can increase your overall net profit. Alternatively, an issue could be either with sales. If the more sales you have, would mean that the more gross profit you have, as long as your cost of goods don't go up. So again, it could be with sales. Alternatively, if your cost of goods are going up, then you could measure the prices you're paying for your cost of goods from year to year. Because if your sales have gone up and your cost of goods haven't gone down to a degree per unit, then perhaps the buying department needs to do better in terms of negotiating better prices, in terms of reducing the overall cost of the goods, therefore maximizing the overall gross profit, as cost of goods minus from the total sales gives you your gross profit. So again, there will be different areas to review and analyze by looking at the profit and loss account, which is very, very interesting, because then it could give management the opportunity to direct their strategies where they should focus in terms of maximizing the overall profits of the business. When you have the net profit then you take off the interest charges, and then you take away the corporation tax, and then after the corporation tax you will decide whether or not you want to give dividends to the shareholders. And if a dividend is given to the shareholders, then that is taken off your figure, and what you are left with are retained earnings, and those retained earnings will link into the balance sheet in terms of shareholders' equity, which we're going to move on to now. Now when we look at the balance sheet consists of your current assets plus fixed assets will equal your total liabilities plus shareholders' equity. So hence the reason why it's called a balance sheet, because it balances. Current assets are those cash equivalents that you have in liquidation that you could sell or have within one financial year. And fixed assets, if you were to sell those assets, would take you longer than one financial year in order to recuperate your monies. So here we have fixed assets plus current assets, which will give you your total assets. If we look at your liabilities, you will have your long-term liabilities that you owe and have to pay in longer than one year, and current liabilities are liabilities that are due and that you owe and have to pay within 1 year. And so the total long-term liabilities and the current liabilities plus the shareholders' equity, which includes the retained earnings that has come from the balance sheet, will equal the total fixed and current assets together. So hence the reason why we've got the balance sheet. Now, when we look at using the balance sheet and the profit and loss account, here we can actually do lots of ratios to determine exactly what's going on in the company. We can do the current ratio, which is looking at your current assets divided by current liabilities to see how well you can pay off all your debts within 1 year. Because if you can't, then potentially there's going to be a problem. If your debtors call in the monies that they're owed and you can't pay it, then potentially it could put you into liquidation. And then we also have the acid test, where you take off the stock and you then divide your current assets minus stock divided by current liabilities. And again, it measures the ability of the company to actually pay all their liabilities within 1 year, taking out the stock of the business. And other ratios you have in here, which includes the return on capital employed, EBIT, which is equal to EBIT, earnings before interest and tax, which is your net profit, divided by your total assets minus current liabilities. So again, once you do this, times 100 gives you a percentage. You can even work out your stock ratio turnover, in terms of which equals your cost of sales divided by your average stock held, to find out how much stock and how long it takes for you to turn over your stock. And these ratios will actually help you to determine what's going well or not going so well in the business. And even if we reflect on Thomas Cook in terms of them being able to pay their debtors within a period of 1 year, then they were not able to do that. And even though they had been in business for over 187 years, they were not able to pay what they owed in 1 year, and therefore they were put and taken to court and put into liquidation and made insolvent. So it's very, very important to monitor your ability to pay the people who you owe money within 1 year. Ability to take out the stock and look at the asset test and see if you can still pay your debtors, to see how well you're doing in terms of ROC, returned on equity informed, and then to look at the stock turnover. And as well as earlier we discussed looking at the gross profit percentage margin and the net profit percentage margin, determining what strategies could be employed within the business in order to increase the overall net profit. So again, it is very important to monitor these costs and to work out exactly what is actually happening in the business, to make sure all the different departments are actually working to their budgets and not going over budget. So each department will have all their budgets for the year, and it's ensuring that the different departments are actually working within their target in terms of the budget set at the beginning of the financial year. And it's so important to interlink this all into the profit and loss account and the balance sheet to ensure that the right decisions are being taken by the management in order to secure the survival of the company.